housing starts, the industry began to turn down 2005, 2006, pre-recession peak in 2005, 2006, and basically crashed into 2009, had a little bit of a bounce back, and then has been stagnating ever since.
Welcome to the Power and Market Report. I'm Albert Liu. Joining me once again is John Williams. He is a recognized expert in government economic reporting. He consults with individuals as well as Fortune 500 companies, and he is the publisher of ShadowStats.com, the often cited alternative statistics source. John, thank you very much for joining me. How are you?
Fine, thanks, Albert. Thank you so much for having me.
It's great to have you back. Again, I've been following you through ShadowStats.com and the communications that you put out. I wanted to talk about a number of things, but let's start with housing. Housing is something that's always difficult, I think, to discern. There's so many different data points that are published by different sources. You talk specifically about September housing starts being down 9% month over month and almost 12% year over year. That sounds pretty bad. Why don't we start there?
Okay. Well, as you say, there are a number of series that are published. The housing starts is part of the residential, the new residential construction number, always very volatile. In fact, I'm surprised they publish it on a monthly basis. They do better to maybe delay it a month or put out a moving average. I look at a moving average because it's so volatile and it gets revised so frequently. It had been stronger, but then you get big downside revisions. It can be up or down 20% in a month, and that's not statistically meaningful. So the numbers themselves are, for a given month, you can't read too much into. If you look at them on the basis of a 6-month moving average, which I think is the way to look at it, you'll see that with the housing starts, and this is true virtually of all the construction series, you have the industry began to turn down 2005, 2006, pre-recession peak in 2005, 2006, and basically crashed into 2009, had a little bit of a bounce back, and then has been stagnating ever since. Right now, the housing starts, and you can look at the aggregate number, the single unit numbers. You're down 50, 60% almost from the pre-recession peak. We've never recovered. That's one area of the economy that is still very much in recession. But you look beyond that to existing home sales, that's down about 20, 30%. The existing real estate market is not down quite as sharply, but it's still down. It's never recovered, still down 20, 30% from its pre-recession peak. If you look at new home sales, you get numbers like the housing starts down 50% or more. This morning we got out the construction spending, which is broader than just the housing market. And if you look at that on an inflation-adjusted basis, it is down year to year by 3%, which is not a good sign that you've actually turned negative year to year. But it's still down 24% from its pre-recession peak. So that you've had no recovery in construction. And the thing that I find very difficult to believe, in fact, I have my own estimates, and indeed this has not happened, is that the broad GDP, the aggregate measure of the total economy, and this is also adjusted for inflation, has recovered as it has in official reporting. If you follow the official story, the economy turned down right at the end of 2007, plunged into 2009, and then started to bounce back. And rather than stagnating as most of the other series have, it just kept recovering. Right now, you're above the pre-recession level by something like 11%, 12%. Yet you're down, depending on the measure, 25 to 50% in the construction trade. If you look at industrial production, which is 65% of the GDP, and that goes that overlaps with the housing numbers, it overlaps with retail sales, but industrial production is down a couple of percent from its pre-recession high. Manufacturing in that is down something like 6% from its pre-recession high. The retail sales, looking for a number that's actually to the plus side since the formal recession, that's up about 5% from its pre-recession high, but nowhere as close to the S&P. And if you allow for the industrial production, it means that the rest of the economy's got to be up 35% from its pre-recession high. It just isn't there. The economy's never recovered. My contention is the economy plunged into 2009. You did have some bounce back, but we've had a period of low-level stagnation, and now it's beginning to turn down again.
John, can I jump in here for a second? It's always possible for looking at these statistics to turn bad news into good news, depending on what your perspective is. Certainly, housing starts going down. That doesn't bode well for affordability, and so that's a first comment. Maybe not good for home builders, top line growth. But the point I want to make, though, is when you talk about getting back to pre-recession highs, we're certainly far from that. But is that a good reference point, considering that the last recession, we were running very hot before the recession, meaning we were in the middle of a housing boom? So should we ever expect to get to those pre-recession highs, if you're talking about the last recession, the 08, 09? Should we ever expect to get back to those highs in the absence of another housing bubble?
I'm virtually certain it will happen. There's no reason the economy can't recover, except the issues are not that you had a bubble per se. Well, you'd had something of a blow-off there. The problem is that consumers lack the liquidity to drive economic expansion, and that comes from the levels of income, credit availability, and the way they look at things, consumer confidence and sentiment and such. You have the problem is we had a banking crisis. We had a near banking collapse. Effectively, it was a banking collapse, although the system itself didn't collapse. The banks still are not functioning normally. That was back in 2008. The Fed, U.S. Treasury, they did whatever they had to prevent a systemic collapse. And they were successful in doing that. They bailed out whatever had to be bailed out. They purchased whatever they had to purchase. I mean, they bought AIG, which is was the world's largest insurer. Bailed out a number of banks. Bailed out General Motors. They guaranteed all deposits. Whatever they had to do, they did. Except they didn't do anything to address the underlying problems with the economy or with the long-term solvency of the United States. First element, without addressing the economy, which is largely a problem of consumer liquidity, they haven't been able to get the economy going again. And in terms of the long-term solvency risks of the United States, they can't fundamentally get the dollar strong. The dollar is strong right now, but that's because of games they've been playing in the markets, and all they're talking now about raising rates, but they're they've basically been working to bail out the global banking system because they won't let it fail. But that whole process has stymied the economy, and at some point, the system will become self-righting. But as long as you've got an economy and a growing population, you should have a growing housing demand.
Okay, John, before we move on, I just want to put a finer point on this. The fury of home building we had going into the last housing bubble collapse, that included building neighborhoods that eventually never were populated. That includes just sort of crazy projects that never should have been begun.
Yeah.
Are you saying that in a healthy economy, we're going to get back to over 100,000 housing starts per month, as the average shows going into that collapse?
Oh, I think you will. It's not that extraordinary in terms of having a reasonably healthy economy and growing population. That's how the population shrinks. That's a different story. But you have, you have the baby boomers that have been working through, but they've had kids and they're having kids, and you get an exponential expansion there. The population is not going away, and people need a place to live. And if they've got a reasonably healthy economy, they can afford to buy houses. What you have to do is get the consumer back into position where he has the confidence and the liquidity to do things such as buy a house. People now, when they buy a house, they don't know what the future is going to be for it. The market prices have been driven higher, some by lack of construction. But part of the issue there is that the average consumer has a difficult time getting a mortgage.
Right, that is a problem. Can I move on, John, to this consumer and talk a little bit about payroll growth? There's a study came out of San Francisco Fed that you took objection to. The administration seems to be happy with 50 to 100,000 jobs growth. You're saying that's recessionary. Can we talk a little bit about the situation in payroll growth?
Sure. Well, we've got payrolls coming up soon, and we've been seeing recently payroll growth in the 150,000 to low 200,000 level, which traditionally is weak. That's not strong payroll growth as most people look at it. If the San Francisco Fed came out and said, because of all the shifting in the demographics here in the economy, we can, if we now get growth of 50 to 100,000 a month, that's enough to give us a healthy employment market. That's nonsense. What's happened with the employment numbers and unemployment, that since the economic crisis really hit, since the panic and the economic collapse, is that the people who have become unemployed haven't been able to get work the way they used to do coming into other economic recoveries in terms of real economic recoveries. And the way the government counts the unemployed, if you haven't looked for work in the last 4 weeks, you're not counted as unemployed in the headline number. They put you in a category called discouraged worker, which lasts for a year. And after a year, if you still aren't, if you've stopped looking for work, but you still want to work, find work, they don't count you at all. They used to count you before 1994 when they redefined the series, because they were coming into the beginning of the NAFTA treaty, which is going to displace a lot of workers, and they changed the definitions of the long-term discouraged workers so that the numbers wouldn't look quite as bad. And indeed, those numbers look quite bad. Now, the thing is, if you look at the unemployment rate, it's down. It's at 5% supposedly is a full employment level. But the drop in the unemployment rate here from 10% at the worst of the recession to the current headline 5% has not been a normal one. This is again the headline number. The number the government puts out 6 levels of unemployment. The third level, U3, is their headline number. Normally, when you get a drop in unemployment, that's a healthy sign, with people no longer being unemployed and gaining a job. What's happened here more often than not is that the number of unemployed has dropped because they're being defined out of existence because they haven't been able to find jobs. So that's not a healthy circumstance. I mean, in terms of the participation rate in the in employment right now, it's more consistent with an unemployment rate of 10%, not 5%. Yet, what the San Francisco Fed was saying, oh, we've had shiftings here in the way people work, and the worker force distribution. They're redefining the numbers for this economic stasis and now renewed recession that we're in. It's nonsense. You've never had the growth. If you take the advertised growth rates of 50 to 100,000 jobs a month, that works out to somewhere between, in terms of year-to-year change, 0.4% to 0.9%. Right now, we're up a little, up around 2%, a little below that. We've never seen the unemployment rate drop to 0.9% or 0.4%. Excuse me, not the unemployment rate. The year-to-year change in payrolls dropped to 0.9% or even lower to 0.4% without the economy being in recession. That's never happened. And in each recession, it has dropped below that and gone negative, but it trails. I mean, it stays in positive territory even when a recession has started, but the growth is falling off, and then it trails the recovery coming out of it. But if they're looking at 0.4% to 0.9% growth in payroll employment, they're guaranteeing you an ongoing recessionary environment.
You know, it's so you mentioned two things. One is the ongoing recession. The other is the dishonesty of the numbers starting somewhere in the mid-90s. And if I put up your plots from ShadowStats, the headline real GDP alongside your adjusted, so the nominal with the ShadowStats deflator, you can see the two, they agree pretty much for a couple of decades, but then you see the slope really change when you get into the 80s and the 90s. And then now the last decade or so, there's just really no agreement whatsoever, and you have a large band stretching from 2008 ongoing, which basically indicates a ShadowStats recession that we're living in right now. Q3 GDP, you say, is not credible, 2.9% annualized. Can you talk a little bit about that?
Sure. Well, what you have to keep in mind here is that over time, the politicians have gotten the numbers adjusted. There are two types of manipulations you get here. One is occasionally you'll have a spot manipulation where someone wants to pick a particular number, let's say for an election. That happened back in 92 with George Bush. People in the administration there worked a manipulation of the GDP outside the Bureau of Economic Analysis, which puts these numbers together. They approached people in industry who reported stronger growth to the Bureau of Economic Analysis. I know this from people who were involved in the process. I'm not giving any qualifications on this. This happened. And I've had it confirmed later by people at the Bureau of Economic Analysis. And so they spiked the economy. The economy came out of its recession. And the feeling was, oh my goodness, I mean, the Bush administration said, yep, we've got a recovery here, and the average guy, Main Street USA, didn't see it. You can't fool a guy on Main Street most of the time. If the average guy's not seeing this, who doesn't sense it, he doesn't believe it. And God bless Main Street USA, because that gives you pretty good guidance. And that's what's happening now. The average person doesn't believe these numbers. Just to be fair, this happens on both sides of the aisle. Another one that was very commonly reported was back in the days of Lyndon Johnson. I know a guy who worked with the Commerce Department at that time and was again involved in the process. Lyndon Johnson was a great politician, and he was very interested in the GDP and back then they called it the gross national product. Basically the same measure, slightly different definitions. But he'd review those numbers every quarter. And if the Commerce Department got the numbers wrong, he'd send them back to the Commerce Department. And he'd keep sending them back to the Commerce Department until they got them right. So this has happened over time. So that's the more unusual thing where you get a point intervention. What has happened generally, though, has been a redefinition of reporting methodology. And you make changes in assumptions. You can change the outlook going forward. Usually the changes in assumption tend to add to the headline economic growth, or it depresses the headline inflation rate. Now, in terms of the GDP, they've added in things recently such as intellectual properties, which are it's not really a legitimate measure, very, very difficult to estimate. And when you do things like that, you need to revise everything back in time, which they do. But they pick to change items that will give them new boosts to the economy. Healthcare is another area there's been a big finagling with. But putting all those numbers aside, there's a big problem with inflation and the way it's reported. And the way the economy standardly reported, it's reported net of inflation. And you can see that with, for example, with retail sales. If you're a retailer, your sales are up 5%. You might say, oh boy, our sales are up 5%. But then you have to ask the question, well, is that because your physical volume of sales is higher, or is that because prices went up by 5%? So that if you deflate for the inflation rate, let's say the inflation rate's 5%, your sales are not up in what they call real terms, the inflation-adjusted terms. And with the GDP, that's also deflated by what they call the implicit price deflator. Problem is that if you understate inflation that you use in dividing, you're going to overstate the inflation-adjusted growth, and there have been very deliberate changes to the inflation measures in the GDP, what they call hedonic quality adjustments, where they have computers that model what the effective inflation rate reduction should be because of all these quality changes that are not necessarily perceived by the public. The effect has been over the period of time that you discussed in the chart, largely to add about 2 percentage points to the inflation-adjusted growth. So that you take that out, that amazingly, I mean, you got to be real suspect of these numbers. The GDP growth has averaged 2% since this recovery, and between the two, if you correct for the inflation, what you'll see is that the real GDP with a more realistic inflation plunged into 2009, and it's been bottom bouncing ever since. That's my contention. That's what I see in other numbers, such as the housing numbers. But let's say we have an unusual event with the housing numbers. You look at the Cass Freight Index, a privately published number. And if you smooth it over a period of a year, because it's not a seasonally adjusted number, or look at the year-to-year change, what you'll see is we plunged into recession, never recovered, and it's turned down again. You can look at the Standard & Poor's 500, broad measure of economic activity of those companies here, broad spectrum of companies. You look at year-to-year revenues, adjusted for inflation and adjusted for all these share buybacks. You reduce the number of shares, and you're looking at revenues per share that gets boosted. But if you look at the aggregate series, total revenues, it's showing a very typical recession pattern, declining negative year to year. That's never happened outside of a recession. Industrial production has contracted year to year now for more than a year. In the 100-year history of the series, that's never happened for more than 2 consecutive quarters. That's happened now for four quarters. You have in the unemployment measures, you're not showing any economic recovery in the broad measures such as the participation rate or the employment ratio, the population, the employment to population ratio. That's a particularly good number because where you have an increasing number of discouraged workers and they don't get defined in the headline numbers, it gives you an indication of the people who are out there. They haven't all just suddenly retired; they're still there. So it's there are a number of indications that this is not quite as advertised.
Yeah, and John, those are all good points. I wonder if you look at Q3 specifically, do you see anything that doesn't make sense above and beyond the normal stuff we see going on with GDP, meaning the normal understatement of inflation that we're accustomed to through the PCE? Do you see anything beyond that would signal to you that this number is even less trustworthy because we're coming up on the election? Today, by the way, is for the viewers November 1st as we record this. Do you see anything sort of extraordinarily suspect?
Well, it's extraordinary from a couple of angles. Let me put it this way: the numbers are traditionally, they've got all sorts of biases and gimmicks built into them, and the last reporting was scope of that. The initial third quarter was a little bit beyond that scope. Reason being that the Bureau of Economic Analysis usually will target. They don't know what's happening. The first estimate. It's a lot of guesses there, and they assume that there's some reasonable judgment on the part of the consensus economists, and usually the consensus economists are wrong, at least in terms of the direction of the economy. They'll always tend to have it on the plus side because most of the consensus economists work for Wall Street, and Wall Street likes to have happy news to sell its products. But they'll tend to target the consensus. The consensus was at 2.5%. It came in at 2.9%, stronger than consensus. So that makes a good headline number, good political number. There are a number of factors there, but one that stands out is the trade deficit. Big improvement in the trade deficit. We'll get more detail on that in the next couple of days. Part of it was a one-time deal with soybean exports, surge in soybean exports that narrowed the trade deficit in the third quarter. But it goes beyond that. It's I'm not going to know the detail on that till we see what they publish on again in a couple of days. But that is one area that probably certainly is questionable. Beyond that, you have the usual gimmicks. I mean, things like the healthcare. They have no good measure of that. They can make those numbers come in anywhere that they want. And once we get past the election, I think you'll find those numbers will revise lower, and you'll end up down below 2%, down in 1%, as reported.
Okay, John, I know you got to run, but I want to get one more thought from you. You talk a lot in your letter about the Fed job owning the economy. This has been going on for years and years. Seems to be one of their primary policy tools at this point. And the stats that you track so closely, they've always been important, but I think they're even more important now because the Fed claims to be in data-dependent mode. So the chairperson will come out and make a statement and say if such and such data looks good, for instance, it'll be a good idea to hike rates in December or sometime after that. I'm wondering from your perspective, how easy or challenging is it to predict what the numbers are going to be beforehand? I'm just wondering if the Fed has a better idea than they let on of what these numbers are going to be that come out in the future.
Well, they do within a limited period of time, and generally they'll know numbers. They'll have a pretty good indication. They may not have the exact number. Among other things, that's not legal, but they can certainly get a pretty good indication about a week in advance. So whatever the number is going to be is pretty well set. The problem is that this bit about the economy and the Fed is just pure nonsense. The Fed is in a circumstance that it can't get out of, doesn't know how to get out of. Again, it goes back to the economic collapse. They did nothing to turn the underlying fundamentals to the plus side, such as the economy. But their concern was not the economy. The concern was the banking system. They had to save the banking system. And to save the banking system, they had to provide it with tremendous liquidity. That's what the quantitative easing was. It was an effort to bail out, and it has to a certain extent bailed out the banking system. But the banking system still is not healthy. It's still not normal. It's not lending normally into the flow of commerce. If it were, we'd have a much more normal economy. But instead of saying, oh, we're bailing out the banks, what they did was they said, oh, we're going to use quantitative easing because the economy's so weak, and we're going to help turn the economy. That's their mandate. Although that's one of their mandates, but don't forget that the Fed's primary function in life is to keep the banking system afloat. And so what they did was they used the weak economy as political cover for the quantitative easing. Then when they stopped the quantitative easing, they didn't quite stop it. What they did was they ceased buying new treasuries. They're still holding $2.5 trillion worth of treasuries, which they're rolling over. And so when they talk about, the economy's got to get back to this point, and then when we're going to start tightening up, that's nonsense. The tightening is tied to the bank's liquidity situation. Now, yes, a weaker economy will hurt the banks, the liquidity circumstances with the banks. So the economy turns down again, which it is. They're probably going to move back towards quantitative easing. But they're not going to talk about that until after the election. And the reason they do all this jawboning, and jawboning is described by Bernanke, and it's been a while since we had him as Fed chairman. The jawboning is their primary policy tool. This is just nonsense. They're saying what they think needs to be said in order to move the markets one way or the other. And consideration that they're going to boost rates has been a factor helping to prop the dollar. But again, that maybe in December they're going to raise rates. They've been crying wolf so many times. The farmers who had that little boy who cried wolf would have strung up the poor little kid by now. This is just nonsense. So maybe they raise them in December. That's the next meeting after this one that's about to come up, where they're not expected to do anything. But maybe they're going to signal a rate hike. So this, they keep moving the markets with this. It's a market manipulation tool. After the election, maybe they'll raise it, maybe not. But their next move is going to be back towards quantitative easing, because the weakness in the economy is still hitting the banks. Their options are trying to bail out the banks. They haven't been able to do that completely. It's a mess. They don't know what to do. They don't know how to get the economy back on track and keep the banking system intact. So that's where the problem lies more than anything else. And I'm not quite sure where it goes. You may have a change in government. However it goes, at least for the next year or so, you're going to have Janet Yellen as Fed chairman. That's when her term expires, and unless you have cause, the sitting president can't get rid of a Fed chairman. It's the system's designed for the Fed to be politically independent.
Okay, John, I think we're going to have to leave it at that. So I want to thank you very much for coming back and sharing all this insight with us. I've been speaking with John Williams. He's the publisher of ShadowStats.com. John, I hope you come back again soon. Thank you very much.
Well, thanks again for having me.
And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing. Until next time, take care. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.